that's the problem with the emotions of investors. They can't get it straight. Right now they're all high-fiving, but in a bear market, they're depressed as they can be, because we know, because we'll always have maybe 1% of the people we do business with will call in and they just can't take it.
Welcome everybody to another episode of Inside the Markets presented by StockPulse.com. We are more than honored to be sitting down today with Ted Oakley, founder of Oxbow Advisors. Thank you so much, Ted, for joining us today.
You bet, Justin. Glad to be here.
So if I'm not mistaken, your outlook on inflation isn't as grim as some have been saying. Could you elaborate on that a little bit to begin?
Well, we've been in that camp, actually, Justin. If you look at it, we owned a lot of oil and metals and fertilizer and timber and all those things really over the past 15 months. We actually have just cut back our oil and energy a little bit, not a lot, but some. And it was when it was up, over 80 and that look. It just looked to us that right now you weren't going to get a further push into that. And so we'll see how that goes. But I have a feeling that the people calling for runaway inflation won't be correct here. I'm not saying you won't have inflation, but it looks more to us like it would be something in the 4 to 5% camp on a longer term basis eventually.
So that doesn't even necessarily parallel with the issues that we saw in the 1970s. Could you describe the parallels that you've seen between today and the 1970 period, 70s period, particularly like say 75 through 79?
Well, the difference then was you had a situation where the baby boomers were, you see, in their 20s, and most of them were in their mid to late 20s, and they were all of a sudden they were in a spending mode. That was the biggest population. So it was demand, it's very much demand driven, and it had to do with building homes, moving in, building families. And we were, things got bid up, but we had so much debt coming on after the Vietnam War that those two things collided together. And when they did, it pressed that, a lot higher. We really feel like we're much more like the 40s. If you look at 1940 through 1954, the 90-day treasury stayed on average at about 1.25%. And yet inflation over that same 14-year period cumulatively went up probably 125%. So what happened is people didn't realize it, but their money was buying less and less and less. And I feel like that's where we are today.
When it comes to the stock market, as we come to a close here, I've seen a lot of fear kind of pick up across all markets, whether that be in Bitcoin or even just stocks generally. Could you speak to where you see stocks at as we close out 2021 and where you think they could be headed?
Well, Justin, you get down to where you only have a couple of weeks left, and you're typically, I've been in the business a long time, and I can't remember a big sell-off in the last 2 weeks of December. There's been some sell-offs obviously in the fall. So I don't think you'll have that much more this year. I suppose they'll end up fairly close to where they are. But going into 22, I think the catch will be that once you get the stimulus bill, I shouldn't say a stimulus bill because it's really just a spending bill, out of the way, and you get into the second and third quarter, there, in my opinion, is where you're going to likely see the trouble. Because if the Fed takes away, all of the bond buying, which I think they may have to take away some of it, and they're late, as usual, always late. And what should happen probably for us is that all that free money or easy money will start to drift away, and then all of a sudden you get into a situation where the markets all of a sudden have to come back to reality, which they have not been in reality at this point.
Can you speak more to how they have not been in reality? We have seen a lot of cash injected into the system since the pandemic started. I guess I believe in late spring was really when the first stimulus hit. We saw, I guess, 6 trillion printed during the first go. Then we saw the spending bill, as you termed it. We've seen, I mean, it's been termed also the infrastructure bill. It's quite large. I remember back when $1 trillion spending was quite staggering, and now that's completely normalized about 12 years later. Could you speak to how the stocks have not been in reality over the last year?
Well, what happens, Justin, when you get so much money being given to everybody, upper end, lower end, middle end, everybody, there's too much cash, then people pay up for things and they get very speculative in what they're doing there. They tend to say, hey, we'll speculate on this, we'll speculate on that. But if you go look at the markets right now, under any number you want to use, I'll use price to sales. Okay, price to sales is 3.5 times. That's never been that high in history. If you think about price to sales at 3.5 times, that means you're going to have to really stay that company, all those companies, a long time before you get your money back. If you look at, forward multiples, they're right on top. The forward regular, not the CAPE, but the forward regular multiple, 21 times, 22 times. If you look at margin debt, all-time high. And that doesn't count what we call off-balance sheet financing they do against stocks, which is a really big area right now. You can't get a number on that. We've tried. I bet it's much bigger than even the margin numbers, though, because that's what these firms do. But you've got all that leverage in the system. And then you've got all of these companies. We have 20% of the companies or so selling at 10 times sales. I mean, if you think about that, you would never, ever even dream about buying a private company at 10 times sales. So we have a very highly speculative nature going on. And then we have the option markets going crazy with all of these people buying options. Very speculative. I don't know if they remember, but you can lose money on options easily. So you have all this put together. And if you look at it, I know it's worked so far this year, and those things do work in markets, but we run a lot of rate of change studies. And when we're talking about rate of change, and we've done this for many, many years, but when the rate of change changes all of a sudden, and over the past 2 months, all of our rate of change studies have turned down. Now, that doesn't mean you're going to go out into crash mode tomorrow, but what it does mean is we have to perk up and get cautious, because that indicator has been too good over the years. And that's where we are right now. We're starting to get cautious. And if it looks like that's going to really continue, you'll see us get much more aggressive with liquidity.
Fascinating. I'm curious, could you speak to, let me back up. Of course, everyone's talking about how we might be in a new paradigm for stocks and many markets that I'm, I guess, adjacent to. Bitcoin, this is starting to be discussed in terms of the crypto index, if you will, that Bitcoin and cryptocurrency has been mainstreamed, and therefore the new prices are just kind of a new paradigm, and they're not going back to the old ones. And this is, I think, a classic signal of a potential top in markets. At least you can it's almost palpable on social media. And I want to speak to you particularly about social media and the way that it's changed investing. So you mentioned some of these stocks are selling at 10 times sales, and a lot of that, at least amongst the younger crowd, is being fueled by apps like Robinhood and also social media websites. So what comes to mind is Tesla. So there's been around Elon Musk, somewhat of a cult of personality, if you will, formulated. And it seems that plays into even professional investors, I suppose, thesis around that stock. Could you speak to the way in which social media has changed investing and the way in which people perceive different stocks, and why you would be cautious about the effects that social media are having on particularly younger investors?
Well, Justin, one of the things I see in social media is that you can write anything. You don't have to back it up with facts. And I see a lot of people put information out. I'll see the tweet back to back, and one will say, this item is so great. The next tweet will say, well, this item is so horrible. And they'll both show things. And, they'll pick and choose, and when you pull out information and which years you want to use and that sort of thing. And that's the one thing about social media. you really don't get a clear look at things because you get the bias of people. Whatever you're biased toward is what you're typically going to write about. And I think that's the problem with social media. And the other problem with it is and this was a big game changer, when we went to no commissions, okay, you created a system and a situation where, particularly for young investors, that this became more like a Pac-Man game that they grew up on. And all of a sudden, they can do things with no cost, just move things around, look at this, look at that. And that created this entire group of people that all of a sudden could do things with a very, very small amount of money, I might add, because used to, if you only had $1,000 and you had to pay, $15, $20 for a commission, well, before long, that wouldn't work for you. But if you're paying nothing, it changes. So they'll go on social media, they'll hear somebody, all of them will group up and go do something, and it works for a little while. It really does. But when it doesn't work is when all of a sudden you go into, and this is what I will see with people, you go into an extended bear market, which none of these people have seen. In March of 22 will have been 13 years since a low. And all of these people, all of them, have done nothing but play in the playground where nothing bad ever happened. When you get into a bear market, though, and you're talking about paradigm, I'll give you an interesting story. We do work all over the country. We do a lot of work in California, even though we're in Austin. But I had 3 people in 1999 that told me to my face in California, they were in tech stocks that they had worked for and had a lot of options and various things. I'm talking about millions. And they all 3 said, it's a new paradigm and you just don't understand it. 3 years later, all 3 of them, 0. That's what happens with these things. People get caught up at them and the greed turns on and they can't quite get clear about where they are. And I see that with most people. And as young investors, you learn. Somewhere along the way, you'll learn. You'll hit the wall. Believe me, I've hit the wall many, many times. But there's nothing like this that's going to last forever. So I think what we've experienced the last 2 years will certainly not be the same the next 2 years.
Could you speak to, for those who haven't experienced one before, or for those who haven't cracked this nut, how one can survive bear markets?
Well, the way you survive a bear market is twofold. One, you have to keep some dry powder. If you don't have an insurance policy on the side, you're going to get hurt. And for us right now, we're about 30% liquid, only because we can't find the things we'd like to buy. With the money you do have invested, though, and this is what would probably throw a lot of them, you'll see markets will crack. They'll rally some. Then they crack and go to a lower low, and they rally and go to a lower low. And every time they go to a lower low, people say, this is the bottom, and I'm going to buy and buy more and buy more and buy more. So by the time you get down to a year and a half or 2 years of that, and it's gone so low at this point that they're losing money on every position they have, it doesn't make any difference what they're doing. That's the point where they just say, you know what, I can't do it anymore, and pull the trigger. See, that's the difference between having cash on the side so your emotions don't rip you up all the time, and you have the ability to say, I've got plenty of money over here, and so if I'm buying something here, I like it, it's good company maybe, even though it's down in price, I can hold through that and not necessarily do something crazy, at the bottom of the market. And that's how we work through those things. You got to be a lot more balanced in a bear market, and you really have to realize when you get those rallies in a bear market, you need to sell some stuff.
Can you speak to some of the indicators that you look at and have developed? For instance, you mentioned your rate of change indicators. Are there any other sets of data that you like to look at or think give you indicators as to what may be coming?
Well, let me just take the rate of change studies first. I think they're important, and not many people use them. I mean, Jimmy Stack at Investec uses something similar called the Kappa curve. It's developed by a guy called oddly enough, out of San Antonio, Texas, many, many years ago. People don't use it much, but what you do is you take a 14-month and an 11-month moving average. It's front loaded. You front load the front. And what you're looking for are convergences or divergences in those averages, which will tell you that whatever that strength is really not as strong as it was. And whatever that weakness is not as strong as it was. So if you're on the weak side, it gives you a really good entry point on the buy. And if you're on the sell side, when markets have been high for a long time, these rate of change studies don't change very often. It's been a long time since we've had something like this. But what happens is when they start to lose momentum, and the way they do that is that you start to get a lot more companies making new lows than new highs. If you look over the past couple of weeks, your new low list is probably twice as high as your new high list. Now, people are not noticing that on the outset. All they see is where the levels of the market are. And then if you look at advanced declines, we normally try to, healthy market, you want to always have more advances than you do declines. When that turns and it goes flat on you, which we've had turn in the last 4 or 5 months now, and you don't have as many advances, it's just telling you that the players in the market, the breadth is not what it was 6 months ago. Doesn't mean you have to go in and sell everything, but it means, hey, you may want to slow down the buying, and you may want to start to look at companies you have that are probably fully priced and pull some. It's not foolproof, but that's what we use. We don't really, a lot of people use all these different technical indicators. We don't use a lot of them, but we use a few of them that have always worked for us. And those are some things we always look at.
I'm curious if you could speak to perhaps where you see the next bear market taking the United States. So this will be the first bear market theoretically post-COVID. So I'm curious if you think that the COVID shutdowns and perhaps some of the supply chain issues that we've been seeing might give this bear market a different kind of feeling.
Well, Justin, it certainly could. If you go through another strain or two and all of a sudden everybody had to shut down or something like that, yeah, there'd be a problem. I think this bear market, though, will be more on valuation. I think valuations are so high today, and people are paying so much, even for private companies, in real estate, everything. I think that's where the trouble lies. I mean, if you're paying $2 for something that's only worth $1, and they're trying to get a decent return off of that, I'm talking about a cash flow return. Obviously, you're only getting 50% of what it should be. And so those are the things we look at. And we've got so many companies that are in that mode today. I can take so many companies and show you where they are in the upper 1 or 2% of where they've ever traded in the history of the stocks. I mean, big companies. And so statistically, yeah, you could say, well, we could keep on going. We might have another good year. We could. I mean, the craziness can always go on. I can't say it wouldn't. But somewhere out there, and I guess as you will get it sometime in 22, you'll start to get, well, you may not get a hardcore bear market. I would guess that you would get some pretty nasty sell-offs during the year that would give you some opportunity. We look at it as opportunity. We get cheaper prices. We like it because we have money, and that's a reason why.
Can you speak to more seeing bear markets as an opportunity?
Yeah, I think what happens with the average investor, this is the problem, okay? Their greed button turns on, and so they're all in all the time. And so the higher they go, the more money they're making. And they open up their accounts every day online and think, gosh, look where I am relative to where I was 3 years ago or 4 years ago. And there's no way I'd want to sell anything. I've got everything in it. And then all of a sudden, you start coming down in price. And you go lower and they're okay for a while, and then you go lower and they're okay for a while. But then there's a point, okay? And one of the books I wrote was entitled Your Money Mentality. And what that book talked about at the very last chapter was, what is your choking point? In other words, what is that point when you're getting lower prices to where you say, you know what? I can't lose any more money. I'm where I can't. I'm at a level right now where I can't. So that person sells stocks at the very low, when if they had had a cash buffer over here on the side, see, they wouldn't have been pressed to get out of the market because they had enough money to get them through the next 3 or 4 years. It's not something where they had to go out and say, you know, I'm in trouble and I have to do this. That's the problem with the emotions of investors. They can't get it straight. You know, right now they're all high-fiving, but in a bear market, you know, they're depressed as they can be, because we know, because you know, we'll always have maybe 1% of the people we do business with will call in and they just can't take it. You know, even though we have cash, they're just not meant for bear markets.
Can you speak to the gold and silver market as we've seen them play out over 2021, and perhaps where you think they could go in 2022, how much they'll get pulled down by a theoretical sell-off?
Well, you're right about that, Justin. People probably don't realize, but when the markets get into a bear market mode, about the only thing that doesn't go down are CDs and treasuries, and maybe muni bonds. But what happens with gold, but it's usually short-lived, by the way, is you'll see the miners and the gold fall off when people are really searching for liquidity in a sell-off, but it doesn't last long. It typically comes right back. And I think for us, that we hold a long-term position, really it's of about 4% in one of our strategies that's nothing but miners in the gold bullion. We won't change that really either way, no matter what, because we own it really as a hedge for us in that particular strategy, and we keep it in there. But gold will sell off. You look at it right now, it's, you know, it went up that 1825 level after being at 2000, you know, back a year ago or so, couldn't get through it. And that was a telltale sign itself. Wouldn't surprise us, okay? Wouldn't surprise us if it doesn't fall back below 1700 or something. However, if it did, and you got it back into the 1600s, it's probably a great buy at that point. So, you know, we would probably add some, but I think people are getting frustrated with it because we've been in a holding pattern now for almost 12 months with gold. It hasn't gone anywhere, a little bit up and down, but that's when they get frustrated, and, you know, they think, well, I thought we were going to really run up here, but it's not working that way. But long run, it probably works, you know.
I'm curious who some of the investors or businessmen are that you've learned from or who you've looked up to, perhaps economists as well.
Well, I'd say some of the investors that I think the most of really is Sir John Templeton was one of my very, very favorite people. I mean, if you watched the way he did things, and just go read his books, you'll find that he knew when to buy and when to sell. And he had a lot of it had to do with emotions. I know the markets were different then, but emotions never change. You know, the stocks, everything changes like that, but not emotions. Emotions are all, we work primarily with business owners after sale all over the country. And even though the business has changed, the emotions never change. And so what happens with Sir John is he gave you all the looks you really wanted. Even though I really like Warren Buffett, and I think he is probably the best accumulator of businesses of anybody in the public realm, and I'll tell you why. He buys companies privately, leaves them alone. He doesn't bring in a bunch of MBAs to try to tell them how they're doing something wrong, you know, and he leaves them alone, leaves a name on the front door. You know, all he wants is his return, and then they split, you know, above that number. That's a smart way to do it. Nobody listens to him, but he's another one that really you can really learn a lot from. There's so many people over the years that I've read economically. You know, I know people. He had people that liked him and didn't like him, but John Kenneth Galbraith was a really interesting person to me, and I've read a lot about him. Had probably some of the most interesting quotes that there ever was, and one of them was and I don't have it exactly, but it had to do with the reason that you have economists around is because they can make the stargazers look a little better. And so, it doesn't go exactly like that. I've got it written down, but my point is he always had a very different look at things. Most economists are always late, so I don't look at them as much as I do. I like to look at people that actually manage money. If you look at people that manage money, then you'll learn a lot more. Just strategists, they're okay, but we're in the trenches every day. And so, and I've learned so much from people that manage money, and that's really what you want to look at. You look at the people that manage money. They'll, and I know a number of really good money managers that have been around. They're sort of under the radar, but they know what they're doing. And so we watch those people.
What are some advantages that those who are in the trenches, money managers, have by virtue of just simply being in the trenches every day?
Well, one of the things you do is you have to be accountable for your decisions. I mean, if when one of the things that happens is, and this has really happened a lot the last 6 or 8 years, you have all these people in the industry that don't know anything about the investing world. In other words, they don't understand balance sheets, income statements, cash flow. They don't know how to value a business or anything. All they do is go out and find 8 or 10 exchange traded funds, or maybe an index fund, throw them in and say, here we go. And they depend on the marketplace to bail them out. Okay. But when you get into times that are tougher, let's say you go into a flat market like 2000 to 2012, the S&P 500 made 0 or certainly less than 1%. Okay. You had to know what you owned. In other words, you had to know the companies you own so that you didn't get shaken out. In other words, you could, you look at a company and say, well, this company is only, if you look at the cash flow or that I'm receiving or the cash flow is producing, it's something that I really want to own. And if I can own that and look at that, that's the difference between being in the trenches and looking at a company and just being what I call a so-called wealth manager that's just going out and choosing a bunch of things that they don't really know what they are. That works well during good times. But when times go poor and you have to really understand what you own, then you need to know what's inside that. Okay. And when we look inside a lot of these exchange traded funds today and mutual funds, believe it or not, they all look alike. They all own the same stocks, the same things, the same hot items, and they may call it a different name and that sort of thing, but it's what I call bull market stuff. And that's the difference between managing money and thinking you manage money.
We've had the honor of sitting down today with Ted Oakley, the founder of Oxbow Advisors. Thank you so much, Ted, for joining us today.
Justin, glad to be here. Thank you.
And thank you, everyone, for listening.